morning. My name's Nick Charteris-Black. It's my pleasure to welcome you to our 2019 Reinsurance briefing. The music was actually designed to quieten you down, but you'd actually already done it, so many thanks for that. And obviously, many thanks for your attendance. We know you've got other meetings, other presentations, and we're really pleased that you choose to be with us here this morning. And I hope you all had smooth journeys to Monte Carlo over the last couple of days. It's a crowded room. I mean, hopefully most people have got some seats. There are a few spare ones. It says reserved for media. Don't worry about that. Come and use them. They're not filled at the moment, and they won't be. So if you don't want to stand at the back, then do come and join us down here. If I can just introduce who else we have on the stage. In fact, the key guys on the stage who will be doing the presentation this morning. In the middle, Bob DeRose barely needs an introduction to these events. Bob heads up our global reinsurance team in Alwick in the US. Also, Greg Carter, Managing Director, Analytics for EMEA and Asia Pacific. Greg has recently located from London to Singapore, but retains responsibility for analytics in London and in Amsterdam, which I'll touch on briefly in a minute. And Carlo is currently based in London, part of our methodology development team. It's a separate team centred out of the US, but Carlos is the European EU representative on that team. And if you do a word search on our methodology, the best credit rating methodology, I think you'll find the word reinsurance mentioned 86 times. And Carlos, in his former life with AM Best, was very involved with our major global reinsurance ratings in Europe. So the format for this morning is pretty similar to previous years. The guys are going to talk to a slide deck for around 45, 50 minutes, and hopefully we'll have time for Q&A at the end of that. There are some other colleagues here from AM Best. I won't introduce you to everybody, but we have a strong representation from 4 offices. But I will introduce you to Matt Mosher, who may put his hand up. He's over there. So Matt, recently appointed President and CEO of AM Best Rating Services, based out of London, based out of the US with global responsibility. And Stefan Holzberger, who is Chief Rating Officer, who is also standing at the back. But do introduce yourself to other colleagues, and we'll be based during the week 2 floors up from here in Salon Gustav. Those of you who are in seats, you will see there's packs which contain, I think, just 2 reports, the Global Reinsurance Report just released and the Lloyd's Credit Report. The slides from today will be available. They'll be sent to you. We've got your details, and then they'll be available on our website over the next couple of days. Finally, before handing over to my colleagues, I wanted to just say a couple of words. I don't really want to say a couple of words about Brexit, but I feel I should. Crash. There you go. Well, what do you read into that? Well, while the technology is being sorted, hint. Anyone like to sort the technology? No, all I wanted to say is actually that we're ready for Brexit. We had to make an early move, like many of our clients, and we established an office in Amsterdam that is now fully operational. And the office is headed up by it's an analytical team there, and the office is headed up by a lady called Angela Yeo, and she is also here at the back of the room, all around. So again, do meet Angela if you get the opportunity. Still no good? Okay, I'll keep going. But essentially, we've moved all our EU27 clients that wanted to move, have now been moved to Amsterdam, being serviced by analytical teams based out of that office. So effectively, hard Brexit, soft Brexit, no Brexit, we're prepared for all eventualities, I would like to think. So I think that was probably all I was going to say around Brexit, and in the UK, we will, if Brexit does go ahead, we'll become regulated by the UK Financial Conduct Authority, and that is also all in place. As I said, only a few words on Brexit. So with that, I think I can now hand over to Bob. you.
Thank you, Nick. And thank you, everybody, for joining us this morning. So our reinsurance presentation, this is basically just a high-level outline. We're going to start off with our market outlook for the reinsurance sector. Then we're going to talk a little bit about the market's performance over the past 5 years, with a little bit of forward thinking or looking forward to what's going to happen over the near term. Then we're going to get into capital and capacity, and then also some recent market developments. So starting off with the market outlook. Last year it was pretty much all doom and gloom when we were here, and in fact we had a negative outlook on the market at that point in time. If you recall, we had come through a pretty bad year for catastrophes in 2017. Midway through the year, there really wasn't much movement in terms of pricing or any improvement in terms of conditions. And the market, in terms of performance, was pretty much at a low. And our thoughts were that while we didn't see much movement in pricing at that point in time, we really believed that the market couldn't perform any worse, that it had to be at a bottom. And based on that, we revised our market outlook to stable. We had no idea what January was going to hold or the subsequent June of 2019. And as it turns out, to our surprise and I guess pleasure, we did see some positive momentum in pricing, which we're going to talk a little bit about today. So when you look at the market outlook, here are our headwinds and tailwinds. And I'm not going to go into every bullet on this page because we're going to talk about them in some depth throughout the presentation. But I think that the three most important things are, one, intense competition. That still remains the same. Excess capacity, that is still very, very much on our radar. And while we're seeing some improvement despite that, we still think that that is a major threat to the long-term sustainability of the improvement that we're seeing today. And then also, I think the other interesting thing here is the increased alignment. This is on the tailwind side. The increased alignment between both traditional and alternative or third-party capital, as we like to call it. That's something that has been happening for the past few years, and I think that the events of the past 2 years have really, really given a lot of transparency around that, and we'll see how that increased alignment, we believe, should help bring more stability to the market going forward in terms of pricing.
Bob, I could just add one thing on the comment on inflation. We talked a little bit last year about expectations that as economic growth started to pick up pace, we'd expect to see broader inflation, and we put forward the theory that actually claims inflation tends to accelerate beyond the sort of normal measures of inflation. I think looking back over the course of a year, we've probably got a less positive view on economic growth now than we did a year ago. We look back a year ago, the US was growing very strongly, and there were signs that even across Europe, there were some signs of growth. I think we've seen a lot of that reverse, and I think what's happening with the US-China trade war is only going to dampen that growth globally. So I think that puts a lid on inflation for now. But I would say we still think it's a longer-term issue for the industry to address.
Yeah. And even though economic inflation may remain low, keep in mind there's also the possibility of social inflation, certainly post-event, that drives claim costs up. And then also medical costs, especially in the US, for lines that are exposed to that, like workers' comp. There definitely is the threat that inflation could lead to some adverse reserve development, which ultimately should bring better underwriting discipline as a whole. So now we're going to get into some performance metrics. And let me first start. All of these metrics are really based on the top 25 global reinsurers that are publicly traded. And it's a consolidated view. And you have to bear in mind that these organizations, while they may be predominantly reinsurance, also have insurance operations. And many of them also have sizable life reinsurance operations. So obviously, all of the combined ratio metrics really talk to the PC results. But when we get into the ROE metrics, that's going to reflect both the PC and the life, both the reinsurance and the insurance. So anyway, when you look at the long-term trend here, it's very obvious that you can see that for 2014 through 16, which were pretty benign from a catastrophe basis, you can see that there's an erosion or a deterioration in the combined ratio performance. And that's really indicative of the weakness that was going on in the pricing fundamentals of the sector. I would say on the reinsurance side, but also on the insurance side as well. The other thing that this slide doesn't illustrate, and it's unfortunate because it was left off, but there is about 6 points of favorable reserve development embedded in each year, 14, 15, 16. I believe 17 it came down to around 4, and 18 remained level at 4. And the interesting thing is that if you factor in the fact that there is favorable reserve development, obviously on an accident year basis, the combined ratios were actually much worse. We have a view that, given the fact that we've been through a period of soft pricing for the past several years, that favorable reserve development is going to continue to wane off, and that there's going to be more transparency and more pressure on the calendar year performance, which should help drive better underwriting discipline going forward. Obviously, 17 and 18 impacted by the cat events. And the one thing that I would say about that is that the 110, not a good number, but when you consider the magnitude of events that occurred in 17 and also the magnitude of events that occurred in 18, those results really, really aren't that bad. And I think one of the major reasons for that is the alignment between both traditional and non-traditional capital. The reinsurers took every advantage to use alternative capital for their own risk management purposes, and that helped bring stability to the operating performance or the combined ratio performance for those 2 particular years. Now, when you look at it over the 5-year, if you look at the 5-year average, the 97.6, really not a very good result, especially when you consider the interest rate environment that we're in. And we'll see later on that the ROE metrics even tell that story better. They're not very, very good. But obviously, these factors, I think, are playing into the driver, to the need for improvement and underlying pricing, both on the reinsurance side, but we're also seeing it on the insurance side as well. Now we get into the same metric, but by segment. And we segment between the European Big Four, US and Bermuda, and Lloyd's. And it's a syndicated market, so the performance is somewhat aligned between the 3 sectors. The interesting thing here really to consider is when you look at the European Big Four, they appear to have more stability over the long term, although a generally higher combined ratio compared to the other 2 sectors. And that's really because they are more broadly diversified. They have a larger casualty component to their business mix. And they also have insurance operations, which certainly play into I would say, better stability in that sector. The US and Bermuda and the Lloyd's more closely aligned in terms of performance. When there's a catastrophe, the numbers really do show in the combined ratio. They tend to be a little bit more elevated. And then for Lloyd's in particular, they have somewhat more of an expense disadvantage, which drives their ratios a little bit higher, especially in cat years.
I think it is worth just highlighting, and maybe because of the scaling it doesn't show, but the deterioration in the performance at Lloyd's is far worse as a proportion compared to the other sectors.
Right. And that's something that's been talked about widely and obviously is driving structural change within that particular market.
We'll come back to that.
So now we're getting into the return on equity metric. And again, here, composite, this also includes reinsurance, P&C reinsurance, insurance, and then also life operations for those entities that have life business centers. Again, you can see the deterioration, 14, 15, and 16. It's been a steady decline year over year, pretty benign cat years on a relative basis. Again, speaks to the fact that there's been pricing erosion in the various product lines and also the low interest rate environment. You overlay catastrophes on those on that situation, and obviously it's very, very difficult to generate any profit at all. And when you look at the 5-year average, it's running about 6%, which is below the industry's average cost of capital. And we'll have a slide later on that dives deeper into that particular analysis. Again, the return on equity by sector. Again, the European Big Four, obviously showing the stability over the long term. The deterioration is true for each of the sectors. But again, the European Big Four generally are better able to remain profitable, even in catastrophe years, because of the ballast that their life operations throw off. You have to keep in mind that because of those life operations, their capacity or their capital is more optimally levered, and they have a larger asset base, which even in a deteriorating yield environment throws off quite a substantial level of investment income, which helps drive stability on an ROE basis.
Yeah, I think that here Bob as well say this slide doesn't just emphasize the diversification that the European reinsurers have and say the presence of primary business and life business. But if we look at the particular indicators as well, we will see that, for example, expense ratios tend to be slightly lower on top of the stability and relatively low combined ratios in general.
And then when you look at Lloyd's, obviously Lloyd stands out, especially in cat years, but you have to bear in mind that that is a very efficient market. They really do not have a high level of balance sheet equity. Therefore, in good years, they really seem to outperform, but in bad years, they really seem to underperform. So while, Greg will talk a little bit more about the initiatives at Lloyd's in future slides, they really do have that advantage in good years and disadvantage in bad. Now, I think that this is a particularly interesting slide. We've showed it in the past, and we think that it's always worth revisiting. And what this is showing is the ROE, the 5-year average ROE. Each pillar is a 5-year average, and you can see that the 5-year average is deteriorating year over year. In the first set of pillars, we're giving credit for the favorable reserve development. And in the second set of pillars, we're removing the benefit of that favorable reserve development. This kind of speaks again to that issue that I brought up when we were talking about the combined ratio, in that, if you take away the benefit of that favorable reserve development, harvesting of prior year's profits, so to speak, the calendar year is performing much, much worse. And the rate of deterioration, speaks for itself. So it definitely points to the need, and I think that for the first time we're starting to see that need being addressed for improved pricing going forward. Now this is the analysis of ROE and comparing it to the weighted average cost of capital. And the blue line being the return on common equity. And as I mentioned on a previous slide, that's running on average about 6%, whereas the average weighted cost of capital is about 7.5%. So in any given year, you're going to underperform your cost of capital depending on really the degree of catastrophes or shock losses that you incur. And you can see that in 2008 and 2011. And again, in 17 and 18, obviously, you're going to underperform your cost of capital because of those shock losses. But you really have to look at it over the longer term. And that's what this chart is showing, and the numbers aren't here, but if you were to look at that blue line, it would say that the average return on equity is about 6%, whereas the cost of capital is running about 7.5%. So you have to ask yourself, and companies ask themselves, are we remaining attractive to our investors? And obviously, this is also driving the need and the resulting pricing improvement that we're seeing for the sector. So now we're going to talk about capital. And obviously, this is an area which is continuing to evolve and one that we're watching quite closely. And this is our AM Best's estimate of total dedicated reinsurance capital. We started this project back in 2012, so we have a longer-term view of it. We work with Guy Carpenter in pulling this information together, but we rely very, very heavily on our proprietary capital model. There are others in the industry that say that dedicated reinsurance capital is somewhere up around $600 or $700 billion. We're not certain how they get to that number, but as I mentioned in my opening comments, most balance sheets are composite in that they're writing reinsurance, they're writing insurance. In the case of Berkshire Hathaway, they have a substantial amount of their capital actually allocated to investment risk. What we do through the capital, using our BACAR model, is we're able to basically go through by line of business and see how much capital is actually dedicated or being deployed to support reinsurance operations. And basically, the darker blue part of each pillar is the traditional capital, on-balance sheet capital. And what that is basically showing you is that really since 2016, it's been pretty much flat. And that's not only because of losses that may have occurred, but also through capital management initiatives. So we're certainly seeing especially in a low ROE environment, you have to compensate your investors for the risk that they're taking by investing in you. So we see share repurchases and dividend activity, trying to manage that capital at a reasonable level, what they feel they need in order to maintain their ratings and to transact business, but to give excess capital, or their view of excess capital, back to their stakeholders. Where we've really seen the growth, and there's another slide that I think illustrates this even better later on in the deck, is in the alternative or the third-party capital, which is that light blue. And obviously that has grown quite substantially, really, since 2012. And obviously, and some used to say that it was a threat to the market. I think that initially it may have been, but I think now we view it more as a tool that traditional players can utilize, and we'll also see that in a later slide, to manage the pricing cycle. And the yellow, or I guess it's green, the green and the red, that's our representation of the amount of alternative capital that is trapped. And at the end of 2018, it was about 20% trapped. These are collateralized deals. The collateral is trapped until the losses are settled. As of year-end 2018, it was about 20%. And we believe that as of mid-year 19, that was down to around 15%. And obviously, as the settlement process works its way through, more and more of that collateral will either be used to pay losses or return to the pool, or very possibly return to the investor if their risk appetite has changed. So even though the alternative capital is flat for our 19 estimate, I wouldn't be fooled by that. We do recognize that there's a lot of capital on the sidelines waiting to come into the space should an opportunity present itself. And indeed, there's a flow. There's an inflow and an outflow. It's just that right now, between the trapped collateral and the outflows, it's really keeping the level of third-party capital contained at this point. Now, working with Guy Carpenter again, they give us some detail in terms of where this third-party capital, who is the manager of the third-party capital. And again, that solid, that darker blue, is the dedicated ILS managers, such as 12 Capital, Nephila, et cetera. Actually, I take Nephila off. They used to be there. They used to be in that dark blue section. You see the growth in the light blue. That's where some of these fund managers have now become aligned with traditional capacity. So the biggest movement, the biggest aspect of growth in that blue is Nephila's ownership by Markel. So when Nephila was acquired by Markel, it moved out of the dark blue into the light blue. So you're actually seeing that more of this third-party capital is becoming aligned, owned, or in some way affiliated with traditional balance sheets. And then the red, which is the small sliver, are dedicated institutional investors, such as Credit Suisse would be an example. And this is just an overview of the top 15 fund managers. And again, there's some interesting points on this slide. I guess the first point, echoing what I said on the previous slide, is that if you look at the notes on the side, you see Nephila, which is now affiliated with Markel, and Renaissance Re are the two largest third-party capital managers in the industry. So they're aligned, they're affiliated in some way with traditional capital. And as I mentioned earlier, we think that that's a good thing for the long-term health of the sector because interests are more closely aligned. And it leads to more rational underwriting. The fewer hands that capital is in, the better it is for the long-term health of the sector. The arrows indicate growth in the fund or shrinkage in the fund, and obviously there's more red arrows than there are green. And what I think that this is really demonstrating is that there is a flight to quality on the part of third-party investors. They've come through, keep in mind, there was a long period of time when everybody was riding the gravy train, for lack of a better phrase, where there weren't many catastrophes. All these third-party managers were making substantial profits, and they were actually decreasing their pricing and still being profitable. And then the events of 17 and 18 occurred. And we're going to go through some of those events and the ramifications of them later on in the deck. But obviously, I think what that has proven is that investors realized that they may have misjudged the risk in the product. And also, they probably realize that there are fund managers that do a better job than others in terms of pricing and selection of risk. And I think that that's why you're seeing, a green arrow in the case of Renaissance Re. They've been able to attract more third-party capital. They have an excellent track record, even in cat years of, I'm going to say, overperforming by having less losses as a result of catastrophes. And then there are a few that have stayed the same. Those are the yellow lines.
So it's interesting, if you look back a few years, a lot of discussions here in Monte Carlo were about the threat of alternative capital,
Yes.
and there was a lot of headlines about, is this the end of the world? Is the market going to change dramatically? Is everything going to be replaced by the capital markets? You don't see that as a comment now. It doesn't seem to be there as a concern, and that alignment seems to have come into play.
Right. And while there's alignment at this level, you have to keep in mind that retrocessional utilization by the traditional reinsurers, a lot of that is going to third-party capital. So there's, I'll call this structural alignment, and then there's a transactional alignment through the purchase of retrocession protection. That has definitely increased. It used to be that Swiss and Munich would never buy retro. Well, in 17 and 18, they did buy retro, and by and large, that went to third-party capital.
I think possibly in a few years' time there won't be the phrase alternative capital. It'll just be a different form of reinsurance.
So, you commonly see this question, in the press. How much capital is going to have to be lost, or what size event? Actually, excuse me. Let me say, what size event will it take to really turn the market? And this was a survey that was done by Artemis, I think, a few years ago. And obviously, you can see that the responses are quite varied, including the one that I think is the most interesting, nothing, the cycle is flat forever. Well, that I'm pretty certain is the most wrong of all of these. There's always going to be cycles. They may be severe, they may be more muted. It's really going to depend on a number of circumstances, and quite frankly, no one really knows the answer. But we try to figure out just how much capital, and there's a difference. The other one was asking about what size event. This is how much capital would have to be taken out of the market before we would see stress. And now there are obviously degrees of stress. I would say that this is a pretty severe degree of stress, but to change the market cycle. And what we do, again, using our capital model, and the footnotes here are extremely important to read. The pillar showing about over $200 billion, that's really the amount of capital that would have to be taken out of these composite balance sheets that we follow. And this is for the top 50 largest reinsurance organizations. So $203 billion out of the top 50 would bring the average BACAR down to 10% at the 99.6 confidence level. The next line is capital utilization. And again, utilizing our BACAR model, most reinsurers that we have dialogue with attempt to keep what they call a capital headroom. In other words, they don't want their capital to fall below a certain threshold. They feel that if it were to go below that, it could put their rating in jeopardy. And that is 25%. Now, it differs by company, but generally speaking, most try to keep their BACAR at a 25 at the 99.6. So what we did is we said, how much capital can we take out of the BACAR model and bring it down to that 25? And that tells us, what's excess and what's being, deployed. So right now, and you can see that it had been as low as 70% was utilized. The utilization has increased to about 80%, so there's about 20% excess capital according to our estimate. And one thing that we have definitely seen really through 17 and 18 is that PMLs had been trending down. They've been laying a lot of their catastrophe risk, either not writing it or laying it off to third-party capital, which brought their net PMLs down, we're starting to see a little bit of growth in the retained PML. Obviously, that says that the pricing dynamics make that risk a little bit more attractive. So that's our thoughts. Now, what size loss would it have to be to lose $200 billion? It'd have to be huge. Because keep in mind, we've had 2 years where we've had $200 billion of losses, and capital has barely moved. So it's really going to have to be a significant event. Now, every event is different. It depends on, the characteristics of the event and how diversified that loss is amongst all of the players. Obviously, you could have an event that, for some reason, isn't that diversified. It may have a more of an immediate impact. But this is just generally speaking. So the news this year, we obviously every year rank the top 50 global reinsurers. And this is a slice of that ranking. This is the top 10 world's largest reinsurance groups. Munich has had the top position for a number of years. This year they actually fell to the number 2 position, Swiss Re taking that. Now Swiss Re has been in the number 1 position in years past. It generally doesn't stay there very long. One of the major reasons why Munich fell to number 2 is because they non-renewed a very large life transaction, which took quite a bit of premium out. The other thing that I would say is that we have organizations like China Re in this listing and Korean Re. They're certainly huge organizations, but I would consider them to be more regional reinsurers than global. But they are obviously expanding their horizons. We see them more on global programs, and they're opening up representative offices around the world. They're obviously looking to do business outside of their home region.
And Bob, probably something that we need to highlight here, because some people, if you just look at total numbers, there might be some differences here. And it's because we make some adjustments here to try to reflect only P&C reinsurance business. So, for example, compulsory business, intragroup business is excluded. And on top of that, in cases where the percentage of the exclusively reinsurance business is below the 75%, we may be making that adjustment as well. So, for example, in the case of Munich Re, we have only P&C reinsurance business, which is not the case of Swiss Re.
Yeah, that's the case. Yes, absolutely. So that's a good point. So Swiss Re, as everyone knows, has a fairly large corporate solutions business. It's a business segment, but that does not approach 25% of the total group premium, so it's actually excluded. Munich Re doesn't break out its corporate solutions business, so it's included. So there are, some ambiguities in the numbers, but again, what we tried to do is rank them based on pure third-party assumed business to the extent that we possibly can. And again, this is just a different slice. It compares the top 10 global. Now, you'll notice that China Re and Korea Re aren't in here because we really don't view them as truly global. So what it does is it brings Partner Re XL and Bermuda up into the top 10. Those organizations do have a very, very strong global footprint. They're able to lead programs across all geographies and regions, and by and large, most classes of business. And there's the top 10 non-life and the top 10 life. Obviously, there are companies that are on both, Munich being on both a life and a non-life basis. But then there are a few pure life reinsurers, Reinsurance Group of America, Great West Life Co. and Pac Life that come into the top 10 global life reinsurance ranking. Now, this hasn't really changed for a very, very long time, and I don't think it ever will, quite frankly. What we're looking at is market share, and basically what this is saying is that the top 10 control close to 70% of the gross reinsurance assumed premium. And then that's followed by, the 11 to 20 controlling the next, approaching 20%. And obviously, M&A is, I know, a topic that's very near to the heart of the media out here, and we'll talk a little bit about that in the future. But when you stop and think about it, if the M&A is really going to occur in that second and third tier, where reinsurers feel they need to gain scale in order to remain relevant to their constituents.
Yeah, I think if we did look back over the years for that chart, it would be that the light blue and the red segments that have probably grown, and the fourth and fifth groups have shrunk.
Yeah, that's probably very true. Yeah, you're right. And again, in those lower tiers, you have some regional players, which play a very important role, especially in Asia. They're indigenous to the market. They have the relationships. They know the clients. They know the product terms well. And there's also regulatory reasons why a lot of those smaller players exist and probably always will.
Yeah.
So this is, talks about the changing landscape, and we've periodically shown this chart over the years. And basically it shows the franchises that survive today. And again, everybody that's in that top 10 is in that first pillar. But the pillar that seems to grow year over year is the sheltered franchises. Those organizations that at one time were independent and possibly publicly traded have been acquired or merged into larger franchises. So they're very viable. You have names like National Indemnity, which is really sheltered by its parent, Berkshire Hathaway. You have PartnerRe, sheltered by Exor, TransRe by Allegheny, and others. The AXA, the XL, XL in theory is sheltered by AXA, but I think that's emerging as a new co-brand on its own merits. But again, I think that the real question I ask myself is I don't see, there might be a few companies in the first pillar that might move over, but I got to tell you, when you stop to think about the landscape, the opportunities for M&A are really becoming less possible just because there are fewer players out there. They've consolidated. That doesn't mean that there won't be new organizations that are born, and this walk continues. And then there's obviously the franchises that are gone. Most of them are the specialists that used to be in Bermuda that specialized in property cat. And with the dynamics in that particular class of business over the past few years, their viability just wasn't sustainable any longer. And then we have, what does the future hold? Obviously, there have been some new franchises that have been born. I would say that, all of these really have an alternative asset strategy. That's a model that certainly is under pressure. I think that it's one of, relevance, finding your position with clients. Some clients may actually be a little bit afraid of that alternative asset strategy and what it might mean for the organization's long-term viability. But again, I think that those models continue to evolve, and it's going to be interesting to see, where it takes them over the long term. A few of these are affiliated with larger carriers. Watford is affiliated with Arch. Its business is sourced through Arch underwriters. Harrington is associated with Axis Capital. Its business is sourced and is 100% assumed from Axis. Fidelis is an interesting story. That started off as an alternative asset vehicle that has morphed into more of a traditional asset strategy with a pure underwriting risk appetite. And here we talk about the price to book, and this is really a long-term view, and it's kind of, this chart is interesting because when you look at the peaks and the valleys, it seems to follow the market cycle quite closely. So if you look at, 2001 to 2000 and it looks like 7, the stock price was well above the average. And then through the softer part of the cycle, the stock price seemed to suffer. There was also an economic financial crisis that occurred in 08, which also, let's say, played a role in bringing that down. But now, over time, it seems like that the price to book is improving. And I don't know, does this speak to a potential hardening of the market? It remains to be seen. But again, when you look at the multiples, and that's in the area below, you can see it goes back, starts at 15, runs through 18. It looks like that the multiples increased and got to their high in March of 18 with AXA and XL, and have since come down. So, what are buyers willing to pay for established franchises? That's the question. Okay, now perhaps the more interesting part of this presentation is, the recent market developments and what is driving the positive, I don't use that word very often, the positive market momentum that we're facing today. And the real question is it sustainable? So it's positive, but is it sustainable? And I don't think we know the answer to the sustainability question. So what this first chart is showing is the growth in alternative capital from 2012 to 2017 and the simultaneous erosion in property cat pricing. And this erosion is what I think really took a lot of the traditional players out of the property catastrophe space to some degree. They may continue to write it, but transfer it through retrocession to alternative capital, but they didn't retain it for their own account. Obviously, I think to some degree, this put more emphasis on non-property cat lines of business, where pricing has also been challenging. But again, we're starting to hear, and we'll see that later on in this presentation, that there appears to be some positive momentum in non-property cat lines of business as well. So, what have the past 2 years really taught third-party capital? And there's lessons that are learned by everybody through catastrophe events. And I think that the most evident or the most interesting story to be learned is that catastrophe losses do have a tail. We heard early on that one of the reasons why third-party capital was interested in the property cat space was, one, it provided an aspect of diversification for them. Two, the modeling was pretty rigorous, pretty good. They felt they had a good idea of the risk. And third, they felt that they would know the cost of goods sold very quickly because the losses, if they occurred, would be paid, and then they would be able to redeploy that capital quite freely. So we've gotten in, and we're going to have a slide here. This one is on Hurricane Irma, and what that proved both to non-traditional and traditional players as well. The reserve tail, which really came out of the assignment of benefits issue, which hopefully everyone is somewhat familiar with, that really caught a lot of people by surprise. Claims that had been closed got into the hands of attorneys and were reopened, and it resulted in adverse reserve development. And because the claims had closed, some of the collateral may have been released. And when the collateral is released, generally, the contract is relieved. The third-party capital has no more obligation to pay the claims. They've been relieved of that requirement. So some cedents that may have closed claims, but then found themselves having to reopen it, even though it may have gone through the reinsurance retention, were unable to collect from the third-party capital because they had novated the contract through the capital release mechanism. So that was one surprise. For those investors that had been held on, they were a little bit surprised because obviously if the capital is tied up because of the collateral requirements, they can't reinvest it. And the longer the money is tied up, the lower the rate of return on the contract. They can't deploy it. They can't earn money on it. It's already been priced and is locked up. So Irma presented the first lesson, I think, of catastrophe reserve tails to the alternative capital. Maria, the same thing. There were keep in mind you had Harvey occurring in Texas, Irma occurring in Florida, and then on top of that, Maria, which predominantly hit Puerto Rico. So resources were already tied up, and because of the devastation that occurred in Puerto Rico, and the fact that it was not really that easily accessible in order to get adjusters on the island, and in fact there was a scarcity of adjusters at that particular point in time, when they had to go into unfamiliar territory, they didn't necessarily understand all of the contract terms and conditions at the primary level in order to settle the claim. And the lack of resources and the fact that there was such devastation, it was hard to get out and actually adjust the claim. That also elongated the tail associated with that particular event. So we had 3 events in close series. This is in 2017. and 2 of them had significantly longer reserve tails than would have been anticipated. And there were also this thing called aggregate covers, and all of these claims were accumulating under that aggregate cover, which ultimately tripped the reinsurance mechanism, and third-party capital suddenly found itself facing a loss, whereas previously they may not have thought one had existed. JEBI. I think that this is the most interesting one of all. Obviously, this is where you see, initial loss picks of $2 to $3 billion developing to between 13 and 15 billion.
Yeah, we've seen some reinsurers assuming that it's potentially up to a $15 billion event.
Right.
If you look at the initial estimates and where that is now, I think this possibly holds the record for the highest percentage shift from where we were looking at then. And actually, I was chatting to a couple of our colleagues from the CAT modelling world before we began this morning, and they were highlighting that even given the numbers that we're talking about now, that event is still only regarded as a 1 in 30 year event.
Wow.
So there's lots of aspects to that sort of rewrite the playbook, if you like.
Right. So I know that there's been a lot of questions as to why it took so long for reserves not only to develop, but why so far off. And it's been so long since they've had a similar event. Obviously there were some voids in the modeling. But also I've heard that most of the Asian companies have a March 30 financial reporting year end. And because of that year end, they didn't feel they had to really hone in on a number as early as the reinsurance counterparty may have hoped them to do. And then also there were resource issues in terms of the adjustment process. And there's even a thought that given the fact that there's so many infrastructure sites in Japan because of the pending Olympics, that it just complicated the adjustment process. So again, these losses to some degree may have aggregated with the losses that occurred in 17 for 3. Keep in mind, some alternative capital covers are written on it for a 3-year term. If they have an aggregate limit, all of these losses occur, they accumulate, and then suddenly third-party capital is called upon to meet some of these obligations. Add to that, the icing on the cake is the California wildfires. And this is a really interesting chart. And this is courtesy of Swiss Re Sigma. Yes, I want to give them credit. I mean, you look at the wildfires that occurred back to the 1980s, wildfires have always occurred. It's just again, it's a natural phenomena in California. But the magnitude, the severity in 17 and 18 really caught everybody by surprise. Again, this is not a very well-modeled exposure. But again, some broad terms and conditions may have included wildfire as a covered peril, and these losses aggregated with the hurricane and the wind perils that occurred elsewhere around the world, and third-party capital was called upon to pay some of these loss obligations. So all of this is really teaching third-party capital some very hard lessons about risk. So what it's leading to is, and there's a word here, possible turn in the trajectory. I mean, we are seeing positive momentum in terms of pricing right now, but capital elasticity is still very real. And while it has flattened, as I pointed out in an earlier slide, the availability of that capital is still very real and could obviously come in if a market opportunity presents itself and either limit that opportunity or take the momentum away. This is why I say I'm not certain we know how sustainable the current environment is for pricing improvement. We saw billions, $219 billion of catastrophes over a 24-month period. Again, that kept capital flat, but it really didn't take any capital out. So if anything is driving the pricing dynamics, it's not so much the supply-demand imbalance, although that still exists. It's really, I think, a new view of risk that is overtaking the market, which is a good thing, a very good thing. And obviously, the majority of the capacity crunch is in the retrocessional markets. We still see earnings as under pressure, because keep in mind, even though if you're getting more pricing, if you continue to have these shock losses, it doesn't allow that pricing improvement to fall to the bottom line. So Dorian, obviously, I mean, a week ago, we were all sitting on the edge of our chairs because it looked like it was going to hit Florida. And what was that going to mean? And that could have been a huge, huge event. Obviously, I have a cousin who lived in Florida, and I called her, and she says, we missed the bullet. And I think that's probably the way a lot of capacity supporting that market felt as well. But we also are seeing increasing demand for reinsurance. I think that the primary players do recognize that they have to do a better job at risk management, especially those players in Florida. So there is definitely an increasing demand for reinsurance, which obviously brings up the demand and helps take advantage of the supply. So this is really just what I was talking about, continued market uncertainty. We have an aggregation of losses that have obviously affected the ILS sector and the traditional sector as well. New capacity being held on the sidelines, and then the loss creep. I mean, Jebi could give off more loss creep. I think we're behind it on Irma and Maria, but you never really know for sure. But all of these factors are really just creating, I think, a sense of uncertainty with where we stand today. And that uncertainty, obviously, is a good thing because it leads to healthy underwriting.
Yeah. I think Jebi seems to have leveled out since about April time. There's not been significant movement since then. So.
Right.
But,
and a lot of the traditional reinsurers may have, learned their lessons early on, and even though the market was the market was saying one thing in terms of where the losses may ultimately end, some of them actually have set reserves aside at a more conservative level. So even if there is creep, it may not impact. So what has transpired? We saw the January and the June renewal negotiations run late. Overall, renewal pricing, now depending on the line of business, flat to up certainly in property cat and retrocession, flat to slightly up in some casualty classes of business. And again, it depends on regional. There's a regional variance to the degree of pricing improvement. I would say that European renewals are generally more flat than US. But the US is a very, very large reinsurance market, so obviously the improvement there can have a significant meaning for the overall market. So in terms of what to expect, capital markets continue to be key to sustain rate increases. They have to embrace and adapt underwriting rigor, and that really starts with the fund manager. And obviously, they're looking to retain their position with their investors, so we think that there's an element of religion that's being learned at that level. But there's still an abundance of capital on the sidelines. And then the evolving interest rate environment, that's a new variable. I think that while interest rates were rising there for a very, very short period of time in the US, we thought that that might take some of the capital out, but now I think longer term we're all facing reality that it's likely that interest rates are going to come down, which may continue to make ILS an interesting proposition, more so than it may have been for a short period of time. Now we get into some of the market dynamics and what's happening, and I think that there are three things that are happening. AIG, obviously in the news quite a bit, coming through a very difficult period, appears to be finally looking to improve its bottom line. We have Lloyd's, similar, and there are other players as well. FM Global is another organization, although I don't have a slide for them, that obviously recognizes the need that they have to improve their bottom line performance. So at AIG, obviously a relatively new management team in control there. They have obviously been recruiting proven talent from the industry in order to change the operating culture at AIG. And they've taken aggressive underwriting actions in terms of pricing, reducing their gross net retained limit, exiting underperforming risks, and increasing their utilization of reinsurance. AIG is a huge provider of capacity to the insurance market globally. So when an organization like this takes underwriting actions, it obviously has a domino effect across the board and allows other players in the market to be more conservative and take advantage of pricing opportunities that result when a leader like this takes these types of actions. Lloyd's.
So yeah, just a few comments on Lloyd's. If you look at the historic performance of Lloyd's, traditionally it's outperformed the markets in the good times and underperformed in the bad times. And so you get a sort of amplification of what's happening in the cycle. And that's still true to a certain extent, but when you dig a little bit deeper into the numbers, then you look at during the soft period of the cycle, sort of up to 2017, then you also saw a deterioration in the non-cat affected performance as well. And that's really where the initiatives to improve the performance at Lloyd's came from, to a recognition of that. And I think that's one of the factors that Bob talked about, the traditional push and pull of supply and demand not seeming to have an impact on the market, even when you've got big loss events. This is an impact on the market that does seem to be having an effect. And it's a little bit of turning around a supertanker. But I would think that probably the individual's name that I hear most often in talking to clients and talking about what's influencing their underwriting policy is John Hancock. And it's not just the Lloyd's operators that are referencing him. The impact that it's had through Lloyd's onto the market seems to be biting. And I think some of the focus on business plans, the decile 10 reviews, that does seem to be bringing that discipline slowly back into the marketplace. I think one of the interesting factors, we didn't talk about it earlier, Bob made some reference to it by talking about Lloyd's being a more leveraged capital base. And that's true, it's always been true. But one of the beauties of that from a credit perspective is that when they do incur losses, they either have to reload each year or they have to write less business. And that brings a certain amount of discipline into the marketplace. And Lloyd's has certainly been pushing heavily on that. And what we have seen is capacity at Lloyd's did come down for this year. So it certainly seems to be having some impact.
Yeah, so two huge capacity providers, AIG and Lloyd's, when they speak, people listen and react. So that's a good thing for the market. And if you follow, some of the publicly traded companies in the U.S., I picked two here. Travelers CEO Alan Schnitzer. In business insurance, we achieved renewal premium change of 6.7%, including renewal rate change of 3.6%. In both cases, the highest level in 5 years. And then Evan Greenberg from Chubb, pricing continues to tighten while spreading to more classes of business and business segments, particularly in the US and London wholesale markets, also seeing early signs of market firming spreading to more territories around the world. So while it used to be that reinsurance and capacity shortages used to drive broad-based hardening in the primary markets, what we're seeing now is that certainly for property cat, I see to some degree that's happening, but for non-property cat lines, it's the primary insurance level that's driving the pricing improvement, and that will benefit reinsurers, especially if you're doing quota share type business. So this is very, very positive news, and hopefully it continues. And then in terms of what the reinsurers are saying, Torsten Genwerk from Munich Re, we see potential for profitable growth in traditional areas of business. There are opportunities to write profitable business in the current market environment. I guess that implies that that was not the case the previous several years, although he doesn't say that. But obviously, it's more favorable today than it had been. And then Everest Re CEO Dominic Adesso, we continue to see positive momentum across underwriting operations with profitable growth opportunities materializing for both our insurance and reinsurance segments. So we're really starting to hear good things from the leadership in the industry. And then there's this potential for opportunities beyond traditional lines, which has existed for many, many years. Cyber, I think that there's an opportunity there. I have to say that I think that the majority of the players are being quite cautious and approaching that possibility in a judicious manner, but there are, it appears to me, others who are writing it for purposes of gaining market share, and again, if they're not controlling their aggregate limits exposed, the modeling in this area is still very, very primitive. And, you know, who knows when there's going to be an event. But if there were an event of a material size, for those who are not approaching it with some degree of caution, could be burned quite badly. We've obviously seen opportunities in the flood space, especially in the U.S. FEMA, the flood plan is buying more reinsurance and more traditional reinsurance. They had utilized alternative as well in the past. Mortgage is an opportunity. U.S. mortgage, Arch is obviously the leader in that space. But again, we're definitely seeing more capacity come into that space. The economics are still rather attractive. My only concern is that they're using it to mask underperformance in other lines. And that's something that we're trying to hone in on. You know, if an organization continues to produce, you know, favorable combined ratios, the question is, well, where are they getting that profit from? If mortgage is masking unprofitable lines of business, that's not a long-term solution to success, we don't believe. Terrorism, increasing, I think, optimism there in terms of product offerings, and I think that is an area that's opening in the future as well. And then InsurTech, obviously a lot of talk about that and what it means for really more in the insurance space in terms of becoming more efficient for the long term. But reinsurers obviously are making an investment for their own benefit, but also for the benefit of their cedents. And that's a way of just making the relationship between the reinsurer and the insurer deeper. So I think I'm running out of time. That brings us back to the outlook, and I'll turn it back to Nick.
Okay, thanks very much, obviously, particularly to Bob, but also Greg and Carlos. I don't think I actually said at the beginning that Carlos is actually going to be joining Bob's team, so you'll be hearing rather more from Carlos next year. We've got around 10 minutes or so for questions. We've got a couple of mics, hopefully, in the room, but if anyone has a question, I've got a couple down here. We've got a man or a lady with a mic. Just down here, Ricardo, if you... Okay.
Hi, thanks for inviting me. First question, I know you mentioned Dorian briefly. I just wanted to know if you could provide an overview what you think the impact will be. I know that it hit more Bahamas than Florida, but I just want to know if you have any initial estimates. Secondly, I didn't take pictures of all the slides because I thought they would be on the reports, but not all of them. So I just wonder if you will send out the slides to us later on, or?
Yes, the slides will be available, yeah. Okay. In fact, if you're really keen, I think they're on a stick you can pick up at the back at the end.
Oh, okay, thanks.
Yeah, as far as Dorian goes, obviously the potential was there for it to be huge. And I think thankfully for Florida, it only skirted the coast. North Carolina's appeared to have been the hardest hit. You know, we're not a modeling firm, so we can guess what the impact might be, but we would, you know, leave the numbers to the modeling firms. And in this case, they should be relatively, you know, good at coming up with a number. I think the modeling is pretty robust, and when the numbers come out, hopefully they'll be somewhat reliable. So I've heard somewhere in the area of $3 to 5 billion for, you know, the island. But obviously there will be some losses in the states, particularly in Carolina, North Carolina and South Carolina. So I don't know, I'm going to guess, and this is the Bob DeRose guess, I'm not going to make a representation for AM Best. I don't think it'll go above 10 billion. I don't think it'll go above 10 billion. I think that's probably conservative. But again, it's still very early.
Did you steal our microphone? Oh, sorry.
Okay.
Yeah, I just had a question, sort of when you talked about this capital waiting on the sidelines. I was just wondering, do you think the profile of that capital has changed since the losses? I mean, is it still mostly kind of institutional money, or do you think it's kind of changed in terms of investors looking at the space?
Well, that's a really good question. The money is obviously still there. I think that, you know, the magnitude of the losses, the the severity and the frequency, and then the resulting settlement process around them has definitely given investors pause. That doesn't mean that they're not going to come back or that new investors may not come in. I think that there's a potential. Obviously, it's very contingent on their view of the risk and the pricing of that risk and whether or not they view it to be attractive. It's still a source of diversification for them, so I think there's always going to be interest. So I think that we're more in a pause, period of pause. The other thing I think that's going on is I think that those investors that do come back are going to look at the fund managers and their track record. Because keep in mind, up until now, there really wasn't a track record. You were giving your money to a fund manager who hadn't really had the opportunity to prove himself because there hadn't been much catastrophe activity. So what exists now is a track record. And I definitely think there's going to be a flight to quality. And those fund managers that performed better will be the beneficiary of managing an increased level of money over time.
Okay. Mark.
Mark Becker, Tiger Risk. So my question is, if you look at the discrepancy between insurance and reinsurance accounting under IFRS 17 today, do you think that's going to have an impact on the market or on your view in terms of winners and losers in the insurance and reinsurance industry? Secondly, what's your view on the impact of ESG potentially on the insurance and reinsurance industry?
Couple of hot topics.
Okay.
Who would
So
like to IFRS 17?
I'll do IFRS 17 and I'll leave
Carlos
to
on
pick up
ESG. Thanks, Mark.
So I think there is a potential for a big impact under IFRS 17. What you need to start from is that when we look at things, and we're looking at things from an economic capital perspective, we're looking at from an economic perspective generally, then a change in reporting format shouldn't change the dynamics, shouldn't change the risk that the industry faces. But the reality is that the reporting requirements will force change, and particularly for those that are writing long-dated either long-dated liability or life contracts. So whilst the risks may not change, the need to report it and how investors then perceive those risks, I think will have an impact. And the danger is that if you've got to crystallise profit or losses up front and recognise those up front, then does that make certain lines of business less attractive for capital to support? Now, it's way too early to say that, but that's clearly one of the impacts that the market has the potential for.
Well, ESG is an interesting topic. As you may know, in Europe in particular, the European Commission is taking it very seriously, and there is a very concrete action plan. Now, from a business point of view, and regardless of what ethical values a company may have, I think that there are two areas where we may think it can potentially have an impact. One is the investment side, the other one is definitely the underwriting risks and the risk of stranded assets. Yeah? So the fact that due to regulatory pressures or to consumer pressures, you would have to divest or shift your exposures away from this considered carbon-intensive areas, and that may have an impact on the financial position of a company. So it's important in those cases where companies are heavily exposed to see what kind of transition and adaptation plans they have.
Anybody else? Ricardo, just one down here.
It's Ivan Bochman from Barclays. You spoke about the surplus capital, but how do you think about the surplus reserves and the balance sheet? We've seen clearly PYD coming down. Do you have any estimate of how much more buffer is there remaining?
Well, again, no one knows for sure. We think that there's less cushion today than there was 5 years ago. And, again, when we have our discussions with management, they always talk about the strength in their reserves. And obviously, they're relying on third-party actuaries as well as internal certified actuaries to come up with their reserve picks. But I think it stands to reason that when you look at the pricing cycle over the past several years and the struggle, and I'm going to use that word, struggle to maintain profitability, that there has been some degree of, I guess, cheating, I hate to use the word, and, or keeping less of a buffer around your loss picks in order to maintain your bottom line, especially if you're a publicly traded organization. So as I mentioned in one of the earlier slides, it had been running at 6 points on the combined ratio, and then it came down to around 4. We think that it could potentially go lower than the 4. And I wouldn't be surprised. I mean, we've already seen pockets of adverse reserve development in certain casualty lines of business. I think that that's going to become more widespread. And then that's what drives, I mean, you saw quotes about the need for pricing improvement or market optimism. Well, that's being driven by, bottom line profitability. It hasn't been where it needs to be. So I think we're going to see more potential pockets of adverse reserve development.
And I think one of the things that could influence that would be if there was an uptick in inflation, then I think that would erode some of that surplus that exists. But at the moment, we're not seeing any signs of that.
Anybody else? Okay, going once. Right, okay, we're bang on 11:30, so we'll wrap up. Thanks again for your attendance. I hope you found it a sort of useful backdrop to the rest of your week. Thanks to the guys.
Thank you.
And if you want to hear more from us, as you can see, there's a number of events coming up over the next few months. If you find yourself in Toronto later in the week, there's a briefing there, a reinsurance briefing in Zurich next week, and then the main London briefing in November. Thank you.